Welcome to the Capital Exchange. I'm Steve Welber, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, following a stellar 2023, a few weeks into January of 2024, the S&P 500 once again is hitting all new time highs.
Still going.
It's crazy. The drop, though, from the previous all-time high for the S&P 500 in January of 2022 lasted 9 months.
Yep.
While the rally took 15 months. It took 2 years or 512 trading days for the S&P 500 to fall from the previous high and then recover to new all-time highs. It's quite a while.
Long 2 years.
It is.
So, Steve, with the S&P 500 sitting at all-time highs, investors are probably asking themselves, what comes next? If you look at the data, you see that the S&P 500 actually does well after hitting new all-time highs. So going back to 1957, the S&P 500 has made an all-time high over 1,100 times.
That's a lot.
It's a lot of all-time highs. So if you were to invest only on the days following when the S&P 500 hit its new all-time high, markets have actually risen at an annualized rate of around 15%.
That's
if you do
a good
that.
return.
It's not too shabby. Yeah.
Yeah, Travis, and true, Travis, and also following the new highs, markets haven't only done well, they've been calm in doing so.
Yeah.
Volatility on the day following an all-time high is about 36% lower than normal, which is really good. And you rarely see big moves in the S&P 500 after hitting that all-time high. And most of the big drops that we have experienced over the years, they don't come immediately after an all-time high. They come after a previous slides or in the middle of the market downturns, don't they?
It's counterintuitive.
Yeah.
People think, it's a new all-time high, we're in for an imminent drop. That's not what the data tells us. So
That's right.
Boring is good here, Steve. Low volatility days on balance, are much better for markets. For example, if we take all the daily returns over the past 60 years for the S&P 500, and let's divide them into two buckets. Days when the S&P 500 was up or down 1.2%, up or down over 1.2%. And then the second bucket is days when the S&P 500 was up or down less than 1.2%. The combined daily returns of all the days where the S&P 500 was either up more or down more than 1.2%, if you add all those together, you end up at about flat, almost about 0%. So that implies that all of the returns we've experienced over the last 60 years have come from those boring days when the market hasn't been as violent. So again, that points us back to the lesson that we always try to tell people or help people with. Time in the market is much more valuable than trying to time the market, particularly when you're at all-time highs.
It's the story of the tortoise and the hare, right?
Exactly right.
This has been great, Travis. I look forward to it next week.
Look forward to it as well.